Welcome to Corporate Sagas. Today we're going to dig into something that's really stirring the pot in economic discussions. The Mar-a-Lago Accord.
Right.
You shared some really interesting articles, and we want to unpack what this proposal actually is, what it might mean globally, and, well, why everyone's talking about it so much.
Exactly. Think of it as getting you up to speed on something that could potentially shift the whole global financial picture, and maybe even your own finances down the line.
Okay. So tell us about the sources we're working with today.
Yeah, we've got a good mix. There's a piece from an investor and financial advisor viewpoint. Then there's a really detailed dive from the Economic Times. Also, a YouTube transcript that lays out the basics of the proposal. And finally, a pretty critical take from the Lowy Institute.
So, multiple angles. Investor, economic press, online summary, and a think tank analysis.
Precisely. It gives us a chance to see the mechanics, but also the, let's say, skepticism it's already facing.
Yeah.
Our job today is kind of synthesize all that, pull out the core arguments, and figure out what's really important here.
Great. Let's start with the name itself. Mar-a-Lago Accord. It obviously brings to mind the Plaza Accord from '85, which was all about weakening the dollar.
It does, yeah. And that's not accidental. This new idea, which the Economic Times links strongly to Stephen Marin, the new chair of the Council of Economic Advisors, also fundamentally aims for a weaker U.S. dollar.
And why? What's the argument for wanting a weaker dollar now?
Well, Marin's argument, laid out in his essay, I think it's called A User's Guide to Restructuring the Global Trading System, is basically that the dollar is too strong right now.
Too strong? How?
He argues it hurts American exports, making them expensive. It tends to benefit the financial sector, maybe more than manufacturing, and leads to these big trade imbalances we keep hearing about.
Okay, so the goal of this accord, as presented in the sources, is to fix those imbalances, boost U.S. industry.
That's the core idea, yes. According to both the Economic Times and that YouTube transcript, it's about competitiveness.
So how would they actually do it? How do you weaken the world's reserve currency intentionally?
Well, that's where it gets interesting and controversial. The investor piece mentions people speculating about a coordinated effort like in '85.
Right.
But it also pours some cold water on that, saying things are very different now, making a direct repeat seem unlikely.
So what are the specific tools being suggested then?
The Economic Times gets into specifics from Marin. One is leaning on trading partners, pressuring them to sell off their dollar reserves, basically asking them to hold fewer dollars.
How would that work?
And then there's this really eye-catching idea, converting shorter-term U.S. government debt, treasury bonds, into ultra-long 100-year bonds.
100 years, wow.
Yeah. And also floating the idea of a user fee for foreign governments holding U.S. debt.
A fee just for holding the debt.
Seems like it. The YouTube transcript picks up on these points too, the dollar weakening goal and these pretty unconventional ways of managing U.S. debt.
It sounds like they expect some pushback. What's the leverage?
Tariffs. That comes up in the investor piece and the Economic Times. Threatening tariffs to get countries to agree to this currency deal.
Okay, so trade pressure.
And the YouTube transcript adds another layer, maybe using security guarantees as leverage too.
Like military protection.
Potentially.
Yeah.
The Lowy Institute analysis echoes this forcing currency appreciation in other countries, the 100-year bond conversion.
Right.
And they explicitly mention the leverage being tariffs and potentially pulling back the U.S. security umbrella.
Okay, this is definitely setting the stage for a big debate. The investor article points out a kind of contradiction, right? Trump policies usually strengthen the dollar, but the administration wants it weaker.
Exactly. It's a fundamental tension. And that article also touches on maybe just acting unilaterally, like taxing foreign-held treasuries.
But that sounds risky.
Oh, yeah. They caution about what that could do to the U.S.'s ability to finance its deficit and, the dollar's whole status as the reserve currency.
Which brings us to the expert reactions. The Economic Times highlights quite a bit of concern.
Significant concern, I'd say. You've got Vicky Redwood from Capital Economics calling the bond swap idea a de facto default. Basically, not paying back debt as originally agreed.
Default, that's a strong word.
It is. And Pictet Bank warns the user fees could be seen as a breach of contract, damaging trust.
So, legal questions, trust questions.
Right. Even those who think it might be technically illegal say you'd need global agreement, which seems like a long shot right now. Plus, you have economists like Adam Slater from Oxford Economics saying the dollar would need to fall by like over 20% to really move the needle on the trade deficit.
A huge drop.
A very significant drop.
And the YouTube transcript, it sounds like it really amps up the warning signals.
It does. It uses phrases like shocking ways to weaken the dollar, massive risks, and potential fallout for, well, everyone, investments, the global economy.
And it mentions experts finding it unworkable.
Yeah, it sums up a lot of the expert opinion as seeing the plan as unworkable and dangerous.
Now, the Lowy Institute analysis seems quite critical too. What are their main points?
They really dig into the economic logic. They argue that just weakening the dollar won't magically fix deficits or bring back tons of high-paying jobs. You need deeper changes in the U.S. economy, investment, productivity.
So it's not just about the currency value.
They argue it isn't. And they make this interesting point that these moves might even strengthen the dollar short term.
How? That seems counterintuitive.
Well, if the goal is to boost U.S. industry, that might require investment. And if the U.S. needs to borrow more from abroad to fund that investment, that could actually increase demand for dollars initially.
Yeah.
It's complex.
Okay. And what about the jobs argument? Lowy is skeptical there too.
Very skeptical. They point out that even if manufacturing grows, technology and automation mean it won't necessarily bring back the same kind of well-paid jobs as in the past. Plus, consumer spending patterns have changed.
Right, the economy's shifted.
They also think focusing so much on the reserve currency status is maybe a bit of a scapegoat. They point to other big factors, like the rise of U.S. tech, the shift to services, things that affect trade balances way beyond just the dollar's value.
What about that 100-year bond idea? What's Lowy's take on the impact of that?
That's a major concern for them. Forcing that conversion makes U.S. treasuries much less liquid, harder to buy and sell quickly.
Which makes them less attractive.
Exactly. And they argue that could actually speed up the process of countries looking for alternatives to the U.S. dollar as their main reserve currency.
So undermining the very status that gives the U.S. economic power.
That's their argument. It undermines a key source of U.S. influence, things like imposing sanctions effectively, borrowing money more cheaply. They see a contradiction, wanting a weaker dollar via the Accord, but also needing the strong reserve status for other goals.
That is a tension.
And their conclusion is pretty blunt. They think the whole plan relies on economic arm twisting that might not work, especially given past frictions between the U.S. and its allies.
So they're calling for pushback.
They suggest international cooperation against this proposal might be needed, basically to maintain global stability and maybe even protect the U.S. economy from itself in the long run.
Wow. Okay, let's circle back to the YouTube transcript comparison with the Plaza Accord. What were the key differences highlighted there?
Right. It stresses that 1985 was a different world. Today's financial system is way more interconnected and complex. China's economic role is huge now, unlike then.
And central banks might not play along.
Their priorities might be different now, yeah. The transcript also maps out potential global fallout, more financial instability, big swings in other currencies, disrupted trade flows, and general geopolitical strain.
So instability seems like a recurring theme.
Definitely.
Did that transcript touch on how this might affect regular people?
It did, yeah. It raised concerns about potential inflation if imported goods become more expensive due to a weaker dollar.
Makes sense.
Also, the cost of traveling abroad would likely go up for Americans. And it touched on how different investments, stocks, bonds, commodities might react, likely with a lot of volatility.
And again, the risk to the dollar's status.
Underlined again. The worry about losing that exorbitant privilege, the benefits the U.S. gets from the dollar being the world's go-to currency. Undermining confidence seems to be the core fear among many experts cited.
Okay, so bringing this all together, the Mar-a-Lago Accord isn't just tweaking things. It sounds like a pretty radical rethinking of how global money and trade should work.
It really is. It comes from a specific view of what's wrong with the U.S. economy and proposes some, let's say, bold and potentially disruptive fixes.
And the debate reflects that boldness. Huge disagreements on whether it would work, whether it's wise, what the real problems even are.
Absolutely. You see these clashing perspectives on the causes of U.S. economic challenges and the best way forward. It's fundamental stuff.
So, for everyone listening, having heard all this, what stands out most to you? Is it the potential upside for U.S. industry that proponents argue for? Or are you more focused on the risks, the global instability, the potential damage to the dollar's role?
Yeah, we genuinely like to know what you think. This is clearly a complex issue with huge potential implications. Drop your comments below. Let's get a conversation going. Your perspective really adds value here.
Definitely. And if you found this deep dive useful for getting your head around the Mar-a-Lago Accord, we'd appreciate it if you'd support the channel. Subscribe, share this discussion with anyone else who might be interested. Thanks for tuning in today.
Thanks, everyone. And maybe one final thought to leave you with.
Go ahead.
If the U.S. does go down this path, actively trying to weaken the dollar using these kinds of tools, what else might happen? What are the unforeseen consequences in a world already kind of looking at other currency options and questioning the old economic rules?
That's a good question. Something to ponder as this whole saga continues to unfold.